In this video, we're going to look at a couple of things. The first thing we're going to do is work our way through a discussion of the actual mechanics of estimating, forecasting cash flows for a project. In addition, we're going to look at a couple of techniques, or if you will, fine-tuning or refinements, some things that we have to take into consideration in the end about the projects that we ultimately do for a company. So the incremental cash flow that we're interested in is what's referred to as a free cash flow. For capital expenditures and depreciation, obviously, capital expenditures are very long term. This is the actual cash outflow and inflow for the particular projects. We obviously want to include these in the project. Depreciation, though, is a non-cash expense, as you remember. So the free cash flow estimate is going to be adjusted in the end for depreciation and any other non-cash expenses. So let's say we have a company, they're proposing a 6-year capital expenditure project. We want to go through the steps of how do we do this analysis, this prediction process. So the first step, we need to estimate sales for the project. So we estimate one sales unit of year one will be 20,000 units. Now, we also expect for this to change over time. So we expect it to grow on an average by about 3% a year with a standard deviation of about 1%. And why do we include the percentages or the standard deviations here? And the reason we do that is to add a level of statistical analysis that can help us maybe predict have better results with our prediction. If we were doing Monte Carlo simulation, this is also something we need to know anyhow. We need to know what the statistical parameters of our variables was. In addition, here we have the price per unit is $75 per unit. It's going to have a growth rate of around 2%. And standard deviation is 0.5%. So what does this look like in a spreadsheet? So here we can see this is the comprehensive project analysis worksheet. We have our units, price per units. Then we have our statistical numbers. So as you see, as we go down this list, what is chosen randomly in these cells is the units plus or minus some standard deviation of growth in each period. And you can see that obviously growth in units is always positive, but it is growing and changing each time. Since we know how units are growing, we know what the sales will be each time. Growth in price per unit, obviously that changes based on our statistics. So now we have net sales for this, in this case, this 6-year window for this company. So we know what the net sales are, or what we're predicting the net sales to be. Step 2, we need to look at the cost of goods sold for the company. And again, we know what the beginning values are, $20 and $6 for direct labor and direct materials, but we also have some growth and standard deviation of that growth to incorporate into our analysis. Fixed costs, in addition, are $600,000. And of course, we have room for other variables in our projection. So here's our variable cost per unit and our fixed costs. Here are statistical analysis, how that all works. And again, we just Once you input the data into these yellow boxes, it will calculate for us the outcome. So our total cost of goods sold each year then is determined through our analysis, our statistical prediction of what we think is going to happen. So our cost of goods sold ranges from about 1.14, it's in that ballpark, around 1.4 to 1.5 million is what the actual cost of goods sold is on an annual basis throughout this time frame. What about estimating selling and administrative expenses? Again, we need to have some forecasting. Again, 120,000 is what we're going to pay for salaries. Here's the growth and standard deviation of that. Advertising is fixed at 40,000. So again, we have 0% growth, 1% here. Again, we need to do the percentage here. Even though it's zero growth, we still need to put in a number here for standard deviation so that the mathematics works down below. Again, here we have the total administrative costs, roughly in that 160,000 odd dollar range per year. And again, these are just predictions, right? So now we have what? We have the sales, we have the cost of goods sold. Now we have our selling administrative expenses. The next step is to look at working capital management. Here's what our ratios are: our days sales outstanding, days carry inventory, days payable outstanding. We have what our current balance is for our assets, current accounts receivable, inventory, and accounts payable. We have our beginning cash is 15,000, which also means then we need to have a number. So the cash as a percentage of sales, we want to keep that around 15%. So that's something we're going to plug in here, that's exactly what we want as far as the amount of cash on hand. And again, these are all calculated over time. And you can see that after the first year, the addition of this project changes the accounts receivable inventory, changes it dramatically over these couple years because of this new project. So again, we end up with our net working capital then is just current assets minus our accounts payable and accruals. So step 4 is calculated as our net working capital that we'll need to run this company for the next 6 years. Step 5. Now we have to look at our fixed asset investment and depreciation. So the cost is $100,000 for one asset, has a 3-year depreciable life. At the end of 6 years, it will be worth $20,000. And likewise, we have a second asset, $750,000. It has a 5-year depreciable life. And at the end of year 6, it can be sold for $100,000. Now, we haven't gotten into a lot of detail about how this depreciation works. You should have had some flavor of that when you were in your accounting courses. But again, we can put up our assets here. Here's 100,000 is our 3-year asset, 5-year asset, $750,000. Now, what you'll note when we go to depreciation, this is not straight line depreciation. This is makers. This is accelerated depreciation. So this is the way the company would actually do this type of accounting for this asset and for its depreciation. So those line items are listed. Here's our current depreciation per year. So we have gross fixed assets start at $850,000, and then every year it declines and reduces out the depreciation per year. So at the end of this time frame, if we've depreciated correctly, we should have 0 in book value, right? There's no money on the books. However, they do have market value. So down below here, the total salvage value you have here is $120,000. So the gain or loss on this is $120,000 in this last sixth year, if you will. Next, we have to finish out our financial statements then. Step 6, we're going to assume the company has a 21% marginal tax rate. Again, this calculates taxes per year. And if you do look, there are a couple years where we have negative income, right? So the second year, we're anticipating negative income that year. Why negative income? Well, we have negative income because we have a huge depreciation expense that year. And that's the way depreciation is supposed to work. It reduces the amount of taxes that we have to pay on our income. So now here we have our net income. We can then construct the balance sheet from our financial statements up above. All of those things fall into place. Step 8 then is to create the free cash flow of the company. And again, this all falls down. Here's our net income, adding back depreciation, taking into account any changes in working capital for the year. So the net cash flow from operations is this line right here. Add to that the cash flow from investment. And here we have our net free cash flow for this company. So this reveals then from this project, this is our timeline. These are the cash flows that we expect to get from this particular project. So step 9 is just to complete the analysis. So in step 9, let me make a little bit more space here. Step 9, we can plug our numbers into our capital budgeting technique worksheet. Here are our cash flows. Down below here are all of our cash flow techniques, our capital budgeting techniques. And you see the net present value is $289,000. Internal rate of return, 25%. So those are all, if we have a discount rate of 13, reinvestment rate of 15% for the MIRR, we say that this is an acceptable project almost across the line. If you look at the net profile mark, you see a rather steep slope, right? We're going to talk about this profile coming up in another video. What this steep slope tells us about sensitivity. The steeper the slope, the more accurate we have to be in our prediction because it is a very important variable. It really affects the outcome of the project. So here we have our process of how we actually predict capital budgeting projects and come up with the statistics and the metrics of measuring those investment projects. So the last slide or two that we're going to talk about are some different types of things that we have to be concerned about. The first thing is something called capital rationing. Capital rationing is when management sets a limit on how much money we're actually going to be able to spend. So sure, many of us have heard our companies say, next year, we're going to spend $20 million on capital budgeting. That's our budget. That's what we're going to spend. That is an example of capital rationing. In theory, capital rationing shouldn't exist, right? Firms should accept all projects that have positive net present value. When companies internally impose these constraints, they do that to avoid what in their mind deems to be excessive levels of new financing, especially debt. But in a world with the law of one price, the separation theorem, with all of the background in understanding how investments work, right? The objective should always be to do all the projects that have positive net present values. They all will make the value of the company go up. So the objective of capital rationing then is a violation of all of that, but it's a real life process and technique and constraint that we have to be aware of. So the objective then is then to find the projects, the set of projects that are going to either give us the highest overall net present value or internal rate of return. So here's the process of how we can do that. Here we have a company, we have 6 projects. We know what the investment is, their internal rate of return, the present value of their inflows. So that also means we know their net present value, right? $20,000, $100,000 minus the investment gives us our net present value. So the first way we can do capital rationing or understand it or utilize it is to rank our projects by internal rate of return. Now we have a worksheet, it's called capital rationing. Rank the projects by their internal rate of return. And then at the same time, we're going to be identifying the cumulative investment of the company. So if we do project 1, which that's a good project, it'll cost us $70,000. If we do project 2, combined with project 1, that's $170,000. So in this particular example, we have a maximum of $250,000 that we're going to spend. So we can do projects 1, 2, and 3, but we can't do project 4 here because we'll spend more than $250,000. So this company will spend $230,000, all of them positive net present values, but we're also ignoring projects A and F that are both positive net present value projects. So again, internal rate of return, we understand its weaknesses, right? But that is one method. In this case, we would do projects B, C, and E. If we do a net present value approach, in this case we rank by net present values. Now you see, again, we're going to do 3 projects, but they're C, B, and A. Why are they different projects? They're different projects because net present value measures growth, internal rate of return measures return, or excuse me, wealth. Net present value measures wealth. So they're measuring different things. Of course, we know net present value is theoretically is the approach that we should use. That will give us the correct answer to maximize the value of the company. Now, again, because we're thinking about capital rationing, we're still ignoring projects, in this case, E and F, that both have positive net present values. So we are losing some value. However, we're not hurting the company. We're just not helping it to the maximum extent. So to see how this might work, the internal rate of return approach ranks these projects by their internal rate of return. As long as the projects have a internal rate of return greater than the cost of capital, again, B, C, E, A, and F, they're all acceptable projects, but with a budget constraint, we're going to cut it off right here. So we're going to do B, C, and E, and unless we can do part of A, we'll ignore all of A and F, and we never would have done D anyhow. So that's capital rationing. Another issue that we might have is when we have 2 similar projects that have different lifespans. Net present value is impacted by the number of cash flows. So if you have more cash flows to add to get to net present value, there is a bias towards longer lived projects. So in this case, we have 2 projects that are very similar, right? One is a cheaper device, has higher maintenance, shorter period of utilization. But the second device, again, more expensive, similar maintenance costs, but it's going to last longer. So if you look at the net present values of the two projects, A and B, B looks like the better project because it has a higher net present value than what A does. However, what this $1,200 here is concerning me because it's part of the addition. It's part of this calculation. So how do we do this? There are two techniques that we can use. One's called the replacement chain, and the other is called the equivalent annual cost method. So essentially, the replacement chain repeats projects until they will begin and end on the same time frame. Then we compute net present value for all of the repeated projects. So we're just going to then calculate the present value of all of those projects, add them all up. That gives us the replacement chain. The equivalent annual cost method converts the net present value into an annuity. It's a little bit easier to conceive, and from a intuitive perspective, it makes it a little bit easier to explain exactly what's going on. So let's look at how these work. Here are our net present values. One has a 3-year life, one has a 4-year life. They're the same project, so they have the same discount rate, the same risk. The annualized net present value, again, sometimes referred to as EAC, equivalent annual cost, $6,000 for project A, that's the short project, and $5,300 for the long life project. So it turns out here that the equivalent annual cost method is higher for the shorter project than the longer project. So again, we would say, even though it has a higher net present value, project A is the better project because it provides, in quotes, annually a higher cash flow than what project B does. If you look at the replacement technique, again, this computation assumes you take years times 3. So this one, in this example, the replacement chain would be done 12 times, right? Or this one would be done 4 times. This one would be done 3 times. And again, it shows us the same answer, that the very short project is going to have a greater return to the company in general than the longer lived project. The other thing we have to be concerned about certainly then is inflation, and how do we deal with this? Certainly we know that there is an interest calculation, and the real rate of interest, we've talked about this from time to time. The real rate is the nominal rate minus inflation. So the nominal rate, the discount rate that we've been talking about, includes inflation. So how do we incorporate inflation into our calculations for capital budgeting? Well, there's 2 ways we can do this. We can adjust all of the cash flows for inflation, which is time consuming, and actually just it shows that it's a little bit less consistent with understanding and the valuation than the other method, which is to utilize the nominal cash flows with the nominal interest rate. So if we're using nominal interest rates, right, the actual cost of capital of the company, then we don't need to adjust the cash flows for real rates, because inflation is incorporated into the cost of financing. So even though inflation is important, we are incorporating it when we utilize the nominal discount rate of the company. So again, that's the end of this video. Hopefully it was helpful. I look forward to seeing you in the next video.